What we are witnessing is not a market fluctuation, but a fundamental recalibration of global financial trust. The catalyst was clear. Over the past 2 years, the United States and its allies took the unprecedented step of freezing hundreds of billions in Russian foreign reserves, assets long considered untouchable, safeguarded within Western institutions. The repurposing of these funds sent an unequivocal message to every capital watching. Dollar-denominated assets are secure only for as long as geopolitics permits. This was far more than a sanction against Moscow. It was a strategic signal to the world, and in Beijing, that signal was received, analysed, and acted upon. China is one of the world's largest holders of US debt. For decades, these treasuries were the bedrock of its reserves, safe, liquid, and reliable. Now, they are increasingly viewed as a strategic vulnerability, a potential lever to be used against them in a future confrontation over Taiwan or technological supremacy. The critical point, often missed in public discourse, is the method. Beijing is not engaging in loud, dramatic sell-offs. There are no fiery press conferences. This shift is deliberate, quiet, and buried deep within balance sheets and quarterly reports. They are allowing bonds to mature without reinvestment, reducing new debt purchases, and moving steadily into gold and non-dollar trade settlements. These are not panicked reactions, they are calculated, strategic decisions, and this is where the situation becomes critically important. When an economic power of China's magnitude begins to prepare for a world where the dollar is no longer the undisputed pillar of finance, the ramifications are profound. Global trade, energy markets, and interest rates, the very foundations of the international system, face recalibration. The US dollar is more than a currency. It is the backbone of modern finance. If that backbone weakens, even incrementally, the shockwaves will be global. Conventional wisdom argues China cannot simply dump the dollar without inflicting severe self-harm. And that is correct. A fire sale would crater the value of their own holdings. But the real strategy is more nuanced. They don't need to dump the dollar. They need only to stop believing in its inviolability. This is a long-term project, slowly reducing exposure, quietly building alternatives, and allowing time to do its work. They are not alone in this endeavour. Nations worldwide are signing non-dollar trade agreements. Central banks are buying gold at a record pace. And even traditional US allies are exploring ways to reduce their dollar reliance. This is not born of rebellion, but of cold, hard precaution. Therefore, the essential question is not if China will liquidate its holdings overnight, but why it has lost faith in the very system that underpinned its economic ascent. When a player of this stature begins planning for a post-dollar world, we must ask, what do they see on the horizon that the rest of the world has yet to fully comprehend? This strategic pivot is what analysts term de-dollarization, a deliberate move to reduce reliance on the American dollar as the world's primary reserve and settlement currency. We have observed Beijing's playbook, diversifying into gold, expanding currency swaps with other nations, and settling more trade in yuan. Furthermore, it has constructed alternative payment systems to bypass Western financial networks. Let us be clear, this is not a sudden repudiation of the dollar. It is a calculated long-term adjustment driven by geopolitical risk and a clear-eyed objective to insulate China from external financial pressure. Over the past decade, the United States has repeatedly weaponized the dollar, employing sanctions, asset freezes, and exclusion from its financial systems. This has demonstrated a hard truth. Control over the global reserve currency translates into control over which nations can fully participate in the global economy. For those heavily invested in dollars, their reserves are no longer mere savings. They have become political leverage, vulnerable to being pulled in times of conflict. That theoretical vulnerability became a stark reality with the freezing of Russian assets. Reserves, once protected by long-standing financial norms, were transformed into instruments of foreign policy. For Beijing, the message was unambiguous. If this could happen to Russia, a major power, then no nation is immune, least of all a strategic rival of the United States. Compounding this geopolitical calculus were pure economic pressures. Rising US interest rates depressed the value of existing treasury bonds, imposing hidden financial losses on China's holdings. What was once considered a safe asset began to look like a significant exposure. In response, China is methodically reshaping its financial defences. It is accumulating physical gold, an asset beyond the reach of foreign freezers. It is channeling investments into non-dollar assets and commodities, and aggressively promoting the use of its own currency in regional trade through bilateral swap agreements. This is not a strategy born of panic, but of cold, clinical risk management. The objective is to reduce exposure without triggering a market shock, to diversify without causing disruption. It is a quiet repositioning for a new era, where finance is a central battlefield of geopolitical power. Practically, this means Beijing is not offloading treasuries in a fire sale. Such a move would be an act of financial self-harm, collapsing the value of its own remaining holdings. Instead, it is simply allowing bonds to mature and choosing not to reinvest the capital. It is a gradual, almost imperceptible withdrawal that steadily diminishes its exposure over time. There is also a crucial currency consideration. A rapid sell-off would strengthen the yuan, making Chinese exports more expensive and directly undermining the export-driven model that underpins its economy and employment. Therefore, this is not about sending a political message. It is a sober, controlled exercise in self-protection, a long-term project to reduce strategic risk without destabilizing the very system it is still navigating. It is the careful, deliberate work of a nation preparing for a more contested financial future. But the ramifications of this shift extend far beyond Beijing. Should major holders like China continue to reduce their exposure to US Treasury bonds, the pressure on the American debt market will become palpable. The fundamental economics are straightforward. Fewer buyers means lower demand. Lower demand, in turn, pushes yields higher. This rise in US borrowing costs would then ripple through the global economy, increasing interest rates on everything from mortgages to corporate loans and sovereign debt worldwide. Emerging markets would face particular strain, as capital could flow back towards higher-yielding American assets. This, however, is more than a simple matter of bond yields. It is a fundamental recalibration of trust. When the world's largest creditors quietly step back from the dollar, other nations take note. Smaller economies and central banks may follow suit, not as an ideological stance, but as a pragmatic act of financial caution. We are witnessing a slow but steady rebalancing of global liquidity, where the US dollar remains dominant, but its supremacy is no longer absolute. And let us be clear, China is not acting in isolation. From Brasilia to Riyadh, nations are quietly adjusting their financial posture. Some are deliberately reducing the dollar's share in their foreign reserves. Others are establishing trade settlements in local currencies. This is not to say the dollar is facing imminent collapse, but it signals a profound shift in how nations perceive and manage financial risk. Countries that once relied entirely on the dollar system are now actively seeking balance, flexibility, and greater sovereignty over their own economic channels. At the very centre of this strategic pivot is gold. Central banks are accumulating bullion at a pace not seen in decades. Gold offers a compelling attribute in the current climate. It is a physical asset beyond the reach of digital freezers or the policy whims of a foreign power. Alongside this renewed focus on gold, we are seeing the deliberate expansion of regional currency systems. More trade between major economies is being settled directly in renminbi, rupees or reals, bypassing the dollar altogether. New financial infrastructure, payment platforms and clearing systems is being constructed to facilitate this very purpose. This is the point where high finance converges with high geopolitics. A currency is no longer merely a medium of exchange. It is an instrument of influence. It determines who has access to capital, who can be isolated from the global system, and which nations can withstand foreign sanctions. When a country chooses to reduce its dependence on a single currency, it is not merely making an economic calculation, it is making a strategic declaration. It is a conscious effort to reshape the global balance of power, gradually moving the world from a unipolar financial order to a more fragmented multipolar one. So we must return to the central question. Is China's move a panic-driven reaction, or is it a deliberate signal? A signal that the old financial rules no longer apply? A signal that safety can no longer be assumed but must be actively built? If China persists on this path and others continue to follow, the dollar's dominance will not vanish overnight. Instead, it will slowly thin. its influence will diffuse. Competing alternatives will grow stronger. We are not looking at a sudden collapse, but the gradual emergence of a world with multiple financial centres of gravity. This is a slow unwind, a controlled transition designed to minimise shock and chaos. It is a recalibration so gradual that its full significance may only be recognised in hindsight. But as history teaches us, the most seismic shifts are rarely announced with fanfare. They occur in the background, hidden in dry data, in subtle policy adjustments, and in 1,000 small decisions that appear insignificant until they coalesce into a new reality. The critical question now is not what is happening, but where it leads. Are we heading towards a deeper, more sustained de-dollarization, a prolonged rush into gold, or perhaps the birth of an entirely new reserve system that will rewrite the rules of global finance? That future is not yet written, but the contours of its foundation are being laid before us, one strategic decision at a time.